What does the current yield curve look like? Have you ever wondered how the yield curve can tell us about the economy? Today, we will take a closer look at what the current yield curve looks like and what it means for capitalism and market trends. The yield curve is a visual tool that shows the relationship between the yield and maturity of fixed-income securities, like government bonds. It helps investors and businesses understand market expectations for future interest rates and economic conditions. There are three main types of yield curves: normal, flat, and inverted. A normal yield curve slopes upward, indicating that longer-term bonds offer higher yields. This usually suggests confidence in the economy. A flat yield curve occurs when yields are similar across different maturities, often signaling uncertainty about the future. An inverted yield curve slopes downward, meaning short-term yields are higher than long-term yields, which can indicate a potential economic downturn. Now let's discuss the current yield curve. As of mid-June 2025, the yield curve is generally upward sloping, but the spread between short-term and long-term yields is relatively small. For instance, the yield on the 10-year Treasury note is slightly higher than that of the 2-year note. This indicates a positive spread, but it is not a strongly upward sloping curve. It suggests that while there is some confidence in the economy, concerns about future economic conditions remain. So, how does this affect investment decisions? Investors often look at the yield curve to decide where to allocate their funds. If the curve is upward sloping, they might prefer longer-term bonds for potentially higher returns. On the other hand, if the curve were inverted, investors might choose shorter-term investments or explore other asset classes. The yield curve also serves as an important economic indicator for policymakers. Historically, an inverted yield curve has preceded many recessions, making it a useful early warning system for potential economic downturns. In the context of capitalism, the yield curve reflects the collective expectations of investors regarding future economic conditions. It influences investment choices and can impact the overall direction of financial markets. While it is not a perfect predictor, it provides essential information for businesses and investors navigating the market in a capitalist system. Understanding the current yield curve can help you make informed decisions about investments and prepare for potential shifts in the economy. Keep an eye on how it evolves, as it can offer valuable clues about what lies ahead.